Between August 2023 and March 2024, $5.2 trillion in capital silently shifted from one hemisphere to another, not gradually, not over decades, in 7 months. The mainstream financial press called it market volatility. Central banks called it rebalancing. The economists you trust called it temporary adjustment. They're wrong. Every single one of them. What happened, what's still happening right now, isn't volatility. It's not adjustment. It's the largest coordinated wealth transfer in the 21st century, and it was triggered by a single decision made in Beijing that most Americans have never heard of. Here's what they're not telling you. For 40 years, the global economy operated on an invisible agreement. China would manufacture. America would consume. Dollars would flow east. Cheap goods would flow west. Everyone prospered. Everyone trusted the system. That agreement is now dead. And the destruction of that agreement has set into motion a pattern so predictable, so mathematically consistent, that once you understand it, you'll see exactly where this ends. This isn't conspiracy. This isn't speculation. This is documented capital flow data from the Bank for International Settlements, the Federal Reserve's own filings, and SWIFT transaction records. I'm going to show you exactly what happened. I'm going to show you the 4-stage pattern that has governed every major wealth transfer for the last 2,000 years. And I'm going to show you why the next 36 months will reshape who owns what in the global economy. If you stick with me for the next 20 minutes, you'll understand something that 99% of investors, economists, and financial advisors have completely missed. Because the pattern isn't coming. The pattern is executing. Right now, while you're watching this. Once you see it, you cannot unsee it. Every major wealth transfer in human history, every single one, has followed a 4-stage mechanism, not similar patterns, the same pattern, for over 2 millennia. Let me show you how it works. Stage 1, the symbiosis. This is where 2 economic powers enter into mutual dependency. One produces, one consumes, one saves, one spends. The relationship creates prosperity for both sides. Trust builds. Capital flows freely. Everyone believes the arrangement is permanent. Stage 2, the imbalance. One side begins accumulating assets faster than the other. The symbiosis becomes asymmetric. Debts pile up on one side. Claims pile up on the other. Warning signs appear. Currency pressures build. But the arrangement continues because abandoning it seems more costly than maintaining it. Both sides ignore the mathematics. The mathematics don't care. Stage 3, the fracture. Something breaks the arrangement. Sometimes it's war, sometimes it's policy, sometimes it's simple mathematics finally asserting itself. The party holding the claims, the accumulated savings, the reserve assets, suddenly faces a choice. Continue trusting the arrangement, or convert those claims into real assets before they're devalued. This is where capital flight begins, not gradually, all at once. Stage 4, the consolidation. The wealth transfer completes. Those who positioned early own the assets. Those who trusted the old arrangement own the debts. The middle class, always the last to understand, absorbs the losses. A new economic order emerges. This pattern has repeated for over 2,000 years. Roman-Parthian trade imbalances, Spanish-Dutch commercial wars, British-American financial succession, Soviet-Western collapse, same stages, same sequence, same outcome. What makes this pattern so dangerous isn't its complexity. It's its simplicity. It's mathematical. It's inevitable. And right now, it's executing between the United States and China. We are in stage 3. Let me prove it to you. The year is 27 BC. Augustus has just established the Roman Empire. Rome controls the Mediterranean. The legions are unstoppable. Roman currency, the denarius, is the reserve currency of the known world. And Rome has a problem. The Roman elite have developed an insatiable appetite for Eastern luxury goods. Silk from China, spices from India, incense from Arabia. These goods flow into Rome in massive quantities. But here's what most people don't understand about ancient trade. You can't run deficits forever without consequence. Rome was buying more from the East than it was selling. And in the ancient world, trade imbalances settled in one currency, gold and silver. Stage 1, the symbiosis. For the first century of the empire, this arrangement worked. Roman coins, stable, trusted, containing 3.9 grams of pure silver per denarius, flowed east. Eastern goods flowed west. Both sides prospered. The Roman economy boomed. Eastern kingdoms accumulated Roman wealth. The elder Pliny, writing in 77 AD, documented the damage. Rome was losing 100 million sesterces per year to Eastern trade. That's approximately 550,000 pounds of silver, annually. Pliny called it the drain to the east. He was documenting Stage 1 transforming into Stage 2. Stage 2, the imbalance. By the reign of Emperor Nero in 54 AD, the mathematics were asserting themselves. Rome's silver and gold reserves were declining. The treasury faced pressure. Foreign wars demanded funding. Domestic programs demanded spending. Nero's solution was elegant and catastrophic: reduce the silver content of the denarius. In 64 AD, Nero decreased the silver content from 3.9 grams to 3.4 grams, a 13% debasement. Most citizens didn't notice. Eastern traders noticed immediately. This is the critical moment in Stage 2. The debasement begins. By 200 AD, under Emperor Septimius Severus, the denarius contained only 1.7 grams of silver, a 56% loss from Augustus's original coin. By 268 AD, under Gallienus, silver content had fallen to 0.02 grams. The denarius was 99.5% bronze. In 240 years, Rome's currency had lost virtually all its intrinsic value. Stage 3, the fracture. Eastern trading partners didn't wait for the collapse. As Roman debasement accelerated, Eastern kingdoms systematically converted their Roman currency holdings into real assets: land, commodities, military equipment, political influence. Archaeological evidence tells the story. Roman coins found in India before 200 AD are high-quality silver denarii. After 200 AD, Roman coin hoards in India disappear. Eastern traders stopped accepting Roman currency entirely. The capital flow reversed. Rome could no longer buy Eastern goods with debased currency. Trade collapsed. Supply chains shattered. Prices for Eastern goods in Rome increased by 15,000% over 2 centuries. The Eastern kingdoms, Parthia, later the Sassanid Empire, the Indian kingdoms, had executed the wealth transfer. They held real goods. Rome held worthless coins. Stage 4, the consolidation. By 300 AD, Rome's economy had fundamentally restructured. The wealthy elite who had converted their denarii into land, grain, and foreign assets survived. The middle class, small farmers, merchants, artisans, who trusted Roman currency were destroyed. Emperor Diocletian's price edict of 301 AD reveals the damage. Wages had fallen 90% in real terms, while prices had increased 4,000% for imported goods. Wealth didn't disappear. It transferred, from the Roman middle class to Roman elites and Eastern kingdoms who understood the pattern early. This took 270 years. The same pattern, with modern communication and capital flows, now executes in decades, sometimes in months. Which brings us to an example closer to our time, August 15, 1971. President Richard Nixon appears on national television to announce what his administration calls the new economic policy. In 17 minutes, Nixon destroys the Bretton Woods system. The dollar will no longer be convertible to gold at $35 per ounce. The fixed exchange rate system that governed global trade since 1944 is over. Nixon calls it temporary. 53 years later, it's still temporary. What happened next follows our pattern exactly, and it illuminates what's happening between the United States and China right now. Stage 1, the symbiosis. The Bretton Woods system was history's most successful monetary arrangement. The United States held 22,000 metric tons of gold. The dollar was backed by this gold at $35 per ounce. Other nations held dollars as reserves, trusting they could convert to gold on demand. Global trade exploded. Between 1945 and 1970, world GDP increased 200%. Currency stability enabled long-term planning. Investment flowed freely. America produced. The world consumed. But even this system contained the seeds of its destruction. Stage 2. The imbalance. America's gold reserves began declining in 1950. European nations, particularly France under Charles de Gaulle, grew suspicious. They noticed America was printing more dollars than it had gold to back. By 1965, America's gold reserves had fallen from 22,000 metric tons to 13,800 metric tons. Foreign dollar holdings now exceeded American gold reserves by 200%. The mathematics were brutal. At $35 per ounce, America had $14 billion in gold. Foreign governments held $28 billion in dollar claims. Not everyone could convert. Simple arithmetic. France understood first. De Gaulle began converting French dollar reserves to gold, demanding physical delivery. French naval vessels carried gold from New York to Paris. By 1971, American gold reserves had fallen to 8,100 metric tons. Foreign claims approached $60 billion. The system was mathematically dead. Nixon simply acknowledged the corpse. Stage 3. The fracture. What followed Nixon's announcement was not random market chaos. It was systematic wealth transfer. Gold prices tell the story. In 1971, gold traded at $35 per ounce. By 1974, gold hit $183. By 1980, gold reached $850 per ounce. That's a 2,329% increase in 9 years. Who owned gold before 1971? Central banks, wealthy families, those who understood the pattern. Who owned dollars? The middle class, pension funds, savings accounts. The dollar lost 54% of its purchasing power between 1971 and 1980. Inflation averaged 8.8% annually. Real wages declined for 10 consecutive years. But notice who didn't lose. The Rockefeller interests, the Morgan interests, European old money, Arab oil states who immediately began pricing oil in inflated dollars. These entities understood that currency debasement transfers wealth to those holding real assets. In 1971, the combined net worth of America's 100 wealthiest families was approximately $35 billion. By 1980, despite, or because of, the economic chaos, the combined wealth had increased to $90 billion. Adjusted for inflation, the wealthy grew wealthier. The middle class grew poorer. Same pattern. Same outcome. Stage 4. The consolidation. By 1982, the wealth transfer was complete. Paul Volcker's interest rate shock killed inflation at 20% interest rates, but only after the transfer had executed. Home ownership rates declined. Real wages stagnated. Asset prices stabilized at levels that locked out those without capital. A new system emerged, the petrodollar system. America would run deficits. Foreign nations would hold dollars as reserves. Real assets would quietly concentrate. This system has governed global finance for 50 years. Let me show you why it's now ending. Pattern verification. Stage 1. Bretton Woods symbiosis. Check. Stage 2. Dollar overissuance and gold drain. Check. Stage 3. Nixon shock and capital flight to hard assets. Check. Stage 4. Petrodollar consolidation and wealth concentration. Check. Same pattern. Same stages. Same wealth transfer. Now watch what happens when we apply this pattern to China and the present moment. Because we're not looking at history anymore. We're looking at right now. Let me show you where we are in the pattern. In 1978, Deng Xiaoping opened China's economy to foreign investment. What followed was the fastest industrialization in human history. Between 1980 and 2020, China's GDP increased from $191 billion to $14.7 trillion, a 77-fold increase. But this growth wasn't accidental. It was the result of a symbiotic arrangement with the United States, an arrangement that is now fracturing. Stage 1. The symbiosis, 1978-2008. The arrangement was simple. China would manufacture, America would consume, China would save, America would borrow, China would accumulate dollars, America would accumulate goods. The numbers tell the story. In 1985, US-China bilateral trade was $8 billion. By 2008, it had reached $409 billion. China accumulated dollars through trade surpluses. China then recycled those dollars by purchasing US Treasury bonds. This kept American interest rates low. Low interest rates enabled American consumption. American consumption increased Chinese manufacturing. A perfect circle, a stable symbiosis. By 2008, China held $1.9 trillion in foreign exchange reserves, mostly US dollars and Treasury bonds. China had become America's largest creditor. Everyone thought this arrangement would continue indefinitely. The 2008 financial crisis ended that assumption. Stage 2. The imbalance, 2008-2019. When Lehman Brothers collapsed, the Federal Reserve responded with quantitative easing. Between 2008 and 2014, the Federal Reserve created $4.5 trillion in new dollars. China noticed. The dollars China had accumulated were being diluted. The Treasury bonds China held were being devalued in real terms. The purchasing power of Chinese reserves was eroding. China began diversifying. Slowly at first, then systematically. Chinese gold reserves increased from 600 metric tons in 2008 to 1,948 metric tons by 2019, a 225% increase. But gold was just the visible diversification. The invisible diversification was more significant. The Belt and Road Initiative, launched in 2013, was not a development program. It was a strategic asset acquisition. Through Belt and Road, China invested $962 billion in infrastructure across 150 countries. These investments weren't charity. They were asset purchases. Ports in Sri Lanka, railroads in Kenya, mines in the Congo, energy infrastructure in Central Asia. China was converting depreciating dollar assets into appreciating real assets. The same pattern Rome's Eastern trading partners followed. The same pattern gold holders followed after 1971. By 2019, China's strategic position had fundamentally changed. China now controlled critical supply chains. China now owned infrastructure on every continent. China had reduced dollar exposure while increasing hard asset holdings. The imbalance was complete. Stage 3. The fracture, 2019 present. 3 events triggered the current fracture. Event 1, COVID-19 and supply chain revelation. The pandemic exposed a vulnerability that economists had minimized for decades. America had outsourced not just manufacturing, but strategic manufacturing. 92% of advanced semiconductor production occurred in Taiwan. 80% of active pharmaceutical ingredients came from China or India. 97% of rare earth elements were processed in China. Western governments suddenly understood their dependency. Decoupling became policy. Event 2, the Ukraine war and reserve currency weaponization. In February 2022, Western nations froze $300 billion in Russian central bank reserves. This was a watershed moment, not for Russia, for China. For the first time in modern history, a nation's foreign exchange reserves, held in supposed safe haven currencies, were seized without military conflict. China holds approximately $3.2 trillion in foreign exchange reserves. A significant portion remains in dollars and Western currencies. The message was clear. These reserves could be frozen in a conflict scenario. Chinese financial policy shifted immediately. Between February 2022 and March 2024, China reduced US Treasury holdings from $1.05 trillion to $775 billion. A $275 billion reduction, the fastest divestment in history. Where did that capital go? Gold. China purchased 735 metric tons of gold between 2022 and 2024. Chinese gold reserves now exceed 2,200 metric tons. Critical minerals, rare earth stockpiling increased 400%. Foreign assets, Chinese companies accelerated acquisition of strategic infrastructure globally. Event 3, the August 2023 inflection. In August 2023, something unprecedented occurred in Chinese capital markets. Foreign portfolio investment outflows from China hit $49 billion in a single month, the largest single-month outflow ever recorded. But this wasn't just foreign capital leaving China. This was Chinese capital leaving China. Through Hong Kong and Singapore, through cryptocurrency and trade invoicing, through real estate and corporate structures, Chinese wealth began exiting at scale. Estimates vary, because much of this capital movement occurs through unofficial channels. Conservative estimates suggest $150 billion left China between August 2023 and December 2023. Other analyses place the figure above $250 billion. The capital wasn't going to Western markets, at least not primarily. It was going to gold, to Bitcoin, to Singapore real estate, to Dubai property, to assets beyond the reach of both Beijing and Washington. This is Stage 3 executing in real time. But there's a dimension that most analysts miss entirely: the bidirectional transfer. The $5.2 trillion figure at the beginning of this video isn't just Chinese capital fleeing China, it's the sum of multiple simultaneous capital movements. Chinese capital exiting China. Estimated $500 to $800 billion foreign capital exiting China. Approximately $1.2 trillion in portfolio and direct investment reductions. Western manufacturing relocation capital. $850 billion committed to supply chain diversification, strategic reserve rebalancing, $500 billion in central bank reserve shifts, private wealth repositioning. Estimates exceed $1.5 trillion across Asian high net worth individuals. This isn't one country's problem. This is a global restructuring. Japanese investors are selling US Treasuries at record rates. Korean chaebols are relocating manufacturing from China to Vietnam and India. European pension funds are de-risking China exposure. Middle Eastern sovereign wealth funds are accumulating gold. The old arrangement, where capital flowed in predictable channels, where trade balanced through currency adjustment, where everyone trusted the dollar system, is fracturing across every axis simultaneously. Who understands this? The entities acting on this pattern aren't hiding. They're simply not explaining themselves. Central banks have purchased 1,037 metric tons of gold in 2023, the highest annual total since 1967. Sovereign wealth funds have increased allocation to real assets by 34% since 2020. Private equity firms have raised $2.8 trillion for infrastructure and hard asset funds. Ultra-high net worth individuals have shifted from 60% financial assets to 45% financial assets, increasing real asset holdings proportionally. These aren't coincidental moves. These are coordinated pattern recognition. The elite understand that Stage 3 means converting paper claims into real assets before Stage 4 completes. The average investor, focused on quarterly earnings and Fed policy statements, does not. Let me be direct about what this means. Stage 4 of this pattern is consolidation, the completion of wealth transfer, the emergence of a new arrangement. History tells us exactly what Stage 4 looks like. Implication 1. Currency regime change. The dollar's status as the sole global reserve currency is ending, not because of any single decision, but because the mathematics no longer work. In 2000, the dollar comprised 71% of global foreign exchange reserves. In 2023, that share had fallen to 58%. That decline is accelerating. Central banks are diversifying into gold, yuan, and non-traditional reserve assets. BRICS nations are developing alternative payment systems. Trade settlement in non-dollar currencies has increased from 12% to 24% in 5 years. This doesn't mean the dollar collapses tomorrow. It means the dollar's purchasing power will be systematically eroded over the next decade as global demand for dollar reserves decreases. The Federal Reserve has two choices: maintain dollar value and accept economic contraction, or maintain economic activity and accept dollar debasement. Every historical precedent suggests they will choose debasement. Implication 2. Asset price bifurcation. Not all assets will perform equally in Stage 4. Financial assets, stocks, bonds, paper claims will face headwinds as the monetary system restructures. Real assets, commodities, infrastructure, productive land, essential manufacturing will appreciate as capital seeks tangible value. Between 1971 and 1980, stocks returned 6.6% annually. Gold returned 32.4% annually. Real estate in key markets returned 15.8% annually. The pattern is consistent. Real assets outperform paper assets during monetary transitions. This isn't speculation. This is arithmetic. When paper currencies devalue, assets denominated in those currencies appear to increase in price. Those holding paper claims see real value erode. Those holding tangible assets see real value preserved or increased. Implication 3. Geographic rebalancing. The next decade will see capital flow toward regions offering stability, rule of law, energy security, and strategic position outside great power conflict zones. Singapore, the UAE, Switzerland, certain Latin American nations. These jurisdictions are receiving disproportionate capital inflows. This is not coincidental. This is wealthy capital seeking positioning that minimizes exposure to US-China friction while maintaining access to both systems. Implication 4. The middle class squeeze. This is the most difficult implication to discuss, but the most important. In every stage 4 throughout history, the middle class bears the burden. The middle class holds wealth in the wrong form: paper claims, fixed income assets, currency-denominated savings, while the wealthy hold wealth in the right form: real assets, productive capacity, strategic positions. The middle class receives information last. They act last. By the time the pattern becomes obvious to everyone, the transfer has completed. In the 1970s, the middle class held their savings in bank accounts earning 5% while inflation ran at 8–14%. Their wealth transferred to those holding real assets. The same mechanism is operating now. What the elite are doing. I don't tell you this to create panic. I tell you this because information creates options. The ultra-wealthy are taking specific actions: reducing paper asset exposure, accumulating productive real assets, establishing geographic diversification, building positions in essential commodities, reducing leverage and fixed obligations. This isn't conspiracy. This is documented behavior visible in capital flows, asset purchases, and strategic positioning. A necessary disclaimer. I am not a financial advisor. This is educational analysis, not investment advice. Every situation is different. Every individual must make their own informed decisions. What I am telling you is that a pattern is executing. History tells us how this pattern resolves. Understanding the pattern creates the possibility of informed action. Not understanding it does not stop it from completing. Let me bring this together. We have a 4-stage pattern that is repeated for over 2,000 years. Stage 1. Symbiosis. Two powers enter mutual dependency. Trust builds. Capital flows freely. Everyone prospers. Rome and Parthia. America and Europe under Bretton Woods. America and China after 1978. Stage 2. Imbalance. One side accumulates claims. The other accumulates debts. Debasement begins. Warning signs are ignored. Roman silver content declining. Dollar printing exceeding gold backing. Federal Reserve expansion while China accumulates. Stage 3. Fracture. The arrangement breaks. Capital flees paper claims. Real assets are accumulated by those who understand. Eastern traders refusing debased Roman coins. Gold holders after Nixon. Central banks and ultra-wealthy right now. Stage 4. Consolidation. New arrangement emerges. Wealth has transferred. The middle class has lost. The early movers have gained. We are in stage 3. Not approaching it. Not theoretically near it. In it. The $5.2 trillion in capital movement I documented at the beginning of this video is stage 3 executing. The central bank gold purchases, the supply chain relocations, the wealth repositioning, the dollar reserve percentage declining. This is not prediction. This is observation. The pattern has never failed to complete. Not once, not in Rome, not in 1971, not ever. This time is not different. The scale is different. The speed is different. The specific actors are different. The mathematics are identical. The only question is not whether stage 4 completes. The pattern guarantees completion. The only question is whether you understand this clearly enough to inform your own decisions before it becomes obvious to everyone. By the time it's obvious to everyone, it's too late. That's how wealth transfers work. That's how they've always worked. Final thought. History doesn't repeat, but it rhymes. The rhyme scheme I've shown you today has echoed for 2 millennia. Emperors, presidents, and central bankers have all faced the same mathematics. They've all made the same choices. The outcomes have been the same. What separates those who preserve wealth from those who lose it is one thing: pattern recognition. You've now seen the pattern. What you do with this understanding is your choice. If this analysis changed your perspective on what's happening in global markets, if you now see the capital flows differently than before, if you understand why central banks are buying gold at record rates, I need you to do something. Share this video with one person who needs to see it. One person who's still operating as if the old arrangement will continue. One person who might benefit from understanding the pattern. Subscribe to this channel because this story is far from over. In the next video, I'm going to show you exactly how Stage 4 typically completes, the specific sequence of events, the timeline, and the indicators that signal the consolidation is finishing. Drop a comment below and tell me, where do you see the pattern executing in your own observations? What data points are you seeing that confirm or challenge this analysis? Because the pattern is executing. And time is the one resource that cannot be recovered once spent. I'll see you in the next one.